Okay guys, and welcome back to the first playlist of Unit 3.1 of the IB Macroeconomics syllabus. Okay, now one of the things that we've consistently said over and over again is that production is wealth. And that is absolutely true, because the more that is produced, the more that everybody on average in a country can consume. But what we're going to do now is we're going to present an idea and a different way. The exact same thing, everything that I've said thus far is 100% true, but we're going to expand our kind of conception of different ways to calculate national income, okay, and different identities, I suppose, that remain true, as well as production being wealth. Now, this is what I would say here. I am going to present this idea to you now. There are three firms in the small economy of Michael's Land. Everything that they produce, they end up selling. Calculate the national income for Michael's Land. Okay, now if you had been watching the previous videos and you were confident and you understood them, what you would probably do is calculate the value of total output. And what I always do with my class is this. I get one group to calculate the value of total output in the economy, one group to calculate the value of total income in the economy, and one group to calculate the value of total expenditure in the economy. And I usually give them a few minutes to kind of do that. And then what actually you should see is that the answer for all three of them is €36. Now, let's ask why. So I'll go back up and I'll just, start the whole question again. Well, let's think about this. Let's calculate the value of total output in the economy. Well, this firm made 3 copies at 50 cents each. Obviously, I'm old. I'm sure all you guys are on computers and stuff like that. Don't even use pen and paper anymore. And then 5 pens at 10 cents each. So for me, that's 3 by 0.5 and 5 by 0.1. I believe that's €2 there. And then we have 5 sandwiches at €2 each. That's €10 value produced of sandwiches by firm 2, and 5 drinks at €1 each. So that's another €5 worth of output that was produced. So I believe that's €15 there. And we have 3 t-shirts at €3 each. Produced by firm 3. That's €9 of value added to the economy by the production of firm 3, from the production of firm 3 of t-shirts. And then 2 tops, forgive me, that's like jumpers, pullovers, whatever you want to say, sweaters, at €5 each. So that's another 10. Now, that's the value of total output. If you add up all of those, I believe you get €36. Now, I did say everything that they produce, they end up selling. Calculate national income. Okay, well, I'm going to skip ahead to the green one here, and I'm going to say total expenditure. So if they sell that means somebody is buying it. And how do you buy a good without stealing it? You hand over money. Okay, so this means now that I've added up total output with you here. Pause the video, check my calculations if you don't believe me, and that's absolutely fine. Okay, so I've added up total output in the economy. And now I'm going to look at total expenditure. Well, if they sell everything, okay, and I know that's potentially a big if, but there's ways around this. But if they sell everything in the economy, well, then that means from the sale of copybooks, okay, they're going to sell 3 of them at 50 cents each, which is €1.50. They're going to sell 5 pens at 10 cents each, which is 50 cents. So again, firm 1, €2 of expenditure. Firm 2, I believe that's €15 of expenditure. And what's this? And I think that's €19 there of expenditure on the output of firm 3. So customers are coming in and giving over €36. They're spending €36. Now, if we work out the total value of income, well, how do firms earn income or revenue more accurately? Well, what they do is they sell their output. So if people are buying something, if there is a transaction between me and you, and I give you €10 for, I don't know, your sandwich, all right? That means that your income is €10 and my expenditure is €10. The income has to equal expenditure, okay? Understand that. So they are going to earn €1.50 from the sale of copybooks, firm 1, and firm 1 is also going to earn 50 cents from the sale of pens. So that's a total income of €2, which was exact same as the value of output and exact same as the value of expenditure on firm 1. Firm 2 is going to, as income, going to sell 5 sandwiches at €2 each. That's €10 that they're earning. And 5 drinks at €1 each. That's another €5 that they're earning. So their income, the owners or firm two's income is €15. That's exactly equivalent to the value of their output, and that's exactly equivalent to the value of the total expenditure in the economy. And firm 3 is going to earn €9 from selling t-shirts and €10 from selling sweaters. So that's €19, which is the exact same as the total output, the value of their total output, and exact same as the value of total expenditure by consumers on their goods. So what we have said is that the answer, no matter how you calculate total output, it's going to be €36. Total income, it's going to be €36 earned from selling this output. And total expenditure is going to be €36 spent on the output that was produced. No matter what, either way you calculate national income, because there's only these 3 firms in the economy, it's going to be €36. So there are 3 ways of measuring national income. One is the income method, and this is where you add up all the money earned by permanent residents of a country over a year. The second one is the expenditure method. This is when you add up all the money spent on final goods and services. Final goods and services. One last time, final goods and services. You may not know what that is yet, but we will come to that later on in this video in a country. And then the output method, which is what we have been doing all the way through. This is where you add up total value of all final goods and services, final goods again, produced in a country in a year. And the strange part is that each of these 3 methods are 100% equal to each other. Now, this is what I want you to understand. I said in the very first national income video in this playlist that please try to get into your mind that production is wealth, for the obvious reason that our standard of living depends on what we can consume, and we can only consume what has been produced. But how do you earn income? Because all of you say it's called national income, and all you say it's about money, okay? Well, how do you earn income? You earn income by producing goods and services and then selling them, okay? That's how you earn income. And still, I feel, in my opinion, everything in economics comes down to production. In macroeconomics, in international economics, and in development economics, when there's not enough production because people are living in developing countries and have a rather low standard of living compared to the more developed countries, all of this comes down to output, the value of production. Okay, so how do you earn income? You produce output and you sell it. Therefore, these 3 methods, these 3 ways of calculating national income have to be the same. So what does this mean, as I've already said? The total value in euros, or in yen, or in dollars, or in tughrik, whatever currency you want to use, of all income, the total value of all income earned by residents of a country is the same as the total value of all expenditure, all the money spent by consumers in that country on final goods is the same as the total value of all goods and services produced. And I want you to see why, again, and just forgive me, you're like, trainer, I got you, it's all about money, I knew it's all about money. No, it's not. Okay, it's not. It's all about production. But how do you earn money? You earn income from producing it and selling it. Okay, and if I said that all prices in the economy were to be divided by 10, but all wages in the economy were to be divided by 10. All savings in the economy was to be divided by 10. All debt in the economy was to be divided by 10. The amount of money that we would be discussing would be reduced by a factor of 10. But as long as the output didn't change, we wouldn't be any poorer. Even though we'd have less money in our account, we would not be any poorer. And the same is true if I said multiply everything by 10. We'd have way more money, but then prices would rise 10 times and we wouldn't be able to buy any more stuff if no more stuff was made. So please, even though these 3 are the same, please understand production is wealth. Now, a quick story to help understand, because I actually found this rather difficult just to kind of get my head around, right? So my mate Gav builds a bike and he sells it to me for €100. That was the only transaction that took place in the economy. What was national income? Well, the expenditure method. How much did I pay for that bike? Well, I spent €100 on that bike. So if I added up all total expenditure in the economy, it'd be €100. The income method. How much did Gav earn from selling me that bike? Well, Gav received as income my €100 that I spent All right, every economic transaction has a buyer and seller. One person is earning money, the seller, and one person is spending money, the buyer. So therefore, if we add up total expenditure or total income, we should get the same amount. They have to be. And the final thing is the value of output, or the output method. And what we're saying, well, Gav made a bike worth €100. Therefore, national income by the output method is €100. No matter how we measure it, using the adding up total expenditure, total income earned, or the value of total output, either way, national income is €100. Now, the mistake that some people make is they kind of add the three together. Please, please, please don't do that. Each of them equal each other. You don't add them. They are three separate ways of looking at the exact same thing. How do I know that Gav made a bike worth €100? Because that was the selling price. And who did he sell it to? He sold it to me. Okay, so don't forget that the selling price is the value of all goods and services. Now, I want you to understand that I said final goods and services, final goods and services, final goods and services. So this is why it's final goods and services. Now think about this, and please do not get confused. Imagine that Trainer's Forestry Company cuts down trees in a forest that it owns and sell these trees to Duffy's Furniture Company for €1,000. Okay, so my second name is Trainer, so this is about my company. So all I'll say is, to kind of prime your minds, is how much value have I added to the economy? I have added €1,000. That's the only thing that's the only clue I'm going to give you now. Duffy's Furniture Company takes my stuff worth €1,000 and cuts it and sands it and fashions it into chairs and tables, and then sells it on to the retailers, Skehan's retailers, for $2,500. Okay, now just think, how much value did Duffy's company add? Just realise that, all right? And then Skehan's retailer sells the chairs to customers for €3,000. And my question is, what is national income? Now, I just want you to be aware that, like everything in economics, it's never simple. It's always awkward. It's always difficult. You know, it's never what you actually think. So I have just said, if you add up all the expenditure or all the income or all the output, you will get national income. So what a lot of people do is, and actually I am quite right, please take a photo of this because we'll be referring to this later on. Okay, so what a lot of people do is they add up all of these three things here, okay, and they get a total value of, I think it was, what was it, 6,500. Okay, so what we're saying here is that the central challenge in measuring national output, GDP, GNI, whatever, is to avoid counting the same output more than once. Now, please have a quick, look at the photo on your phone, and so you can check the total values and the selling prices. It might seem obvious that total output should simply equal, you just add everything together. Okay, but it's not that simple. If you were to do this, okay, that means you would end up counting the same output a number of times, which would overstate the value of national income. So, I cut down wood and sold it for 1,000. Duffy sanded it and sold it for 2,500, and my mate Skehan just sold it, right, for 3,000. So if we add up all of this, we get 6,500. That is incorrect, and please, please, please do not get frustrated if you got that, because I want you to understand this, and it is a perfect way to learn by making mistakes through the process. Now, if we did this, think about this, okay? It would overstate the value of national income because of this idea of double counting. So the value of this wood, I created that. I added €1,000 of output to national income, or to national output, whatever way you want to look at it. Now, I know Duffy sold the sanded wood and tables and chairs for 2,500, but included in this 2,500 is the value, the €1,000 that I have also produced and given him. So if we added this as 2,500 in this chain here, then you would be counting the value of the wood that I chopped down twice. You'd be counting it here and you'd be counting it here. If you added the €3,000, you'd be counting the value of the wood that I chopped down 3 times, here, here, and here, and the value of Duffy's efforts twice, here and here. So that would incorrectly overstate national income. All right, please, please, please don't get confused. I promise you guys, or I promise you've got this. So forgive me, I've said all of that. If you want, you can just pause the video and read that, but I have said all of that, okay? Now, what we're going to say is a great way to avoid double counting using the output method, Okay, and it's not even this difficult in the IB, but a question like this could come up, okay, is to focus on the value added at each stage of production. Okay, this is called the value added method, and the output method is a way of using the value added method. So let's have a look at this. I had no non-labor inputs. I just took something from the earth, chopped wood down, and it was worth nothing in its state, but because of my labor, I added €1,000 of value to the economy. Now, what Duffy did was he took something of €1,000 worth of value, because that was its selling price. It's an intermediate good. It's not a final good because it's going on to another stage of the production process. And then he sold it on for 2,500. So the amount that Duffy added was the amount that he sold it for minus the amount that it cost him to buy the inputs from me. So Duffy added 1,500. I added 1,000. Duffy added 1,500. And then Skian, what he did was he made it easier for the consumer to come and buy this stuff. That's a service. Okay, he didn't add anything in terms of value to the product itself, but he added a service to the consumer so they could come along to his showroom and say, okay, I'll buy that Skeiner. All right. So basically, he took something worth 2,500 and he sold it for 3,000. So the value that Skian added as a result of the showroom service was 500. So therefore, I added 1,000, Duffy added 1,500, and Skian added 500. Okay. So if you add up all of those, you get 3,000. Okay. And that is the value added method. Now, I did say the total output equals total expenditure equals total income. Okay, now let's think about this. All right, total expenditure is the total expenditure that takes place on all final goods and services. Well, what is the final price it was sold from all kind of people involved in the production process to the consumer? 3,000. Skian sold it to the final consumer for 3,000. What did we just calculate? The value added method, which was the output method, is 1 plus this, is also 3,000. How much did each of us earn when we take away our selling price minus our costs? Well, I didn't have any costs, so I earned 1,000. Duffy had to buy something off me for 1,000, but he sold it for 2,500, so there's 1,500. And then Skian had to sold something for 3,000, and he bought it for 2,500, so he earned 500. So it's 1,000 income plus 1,500 income plus 500 income again equals 3,000. So yes, total output equals total expenditure equals total income. But when there's stages in the production process, like what we've seen here, then it can get a little bit trickier. But at the end of the day, if you understand, this is 100% true, that national income equals national output equals national expenditure. Okay, now let's have a look further on. Okay, I don't know why I had that as a thing here. Now, again, this is not an IB question. This is from a different economic syllabus, but I think it's no problem, okay, to go through this kind of stuff. Now, I'm obviously not going to answer, well, I am. So one method for calculating national income is the output method. Outline two other methods used to calculate national income, and describe the problem of double counting when compiling national income statistics. Okay, well, the other two methods are the income method and the expenditure method. Now, the income is earned by factors of production. They are the things that produce the goods and services that you and I enjoy. You get income from production. So therefore, in this example, only factors of production can earn income. You may be saying, well, hold on a second, if you're unemployed in developed countries, you actually get unemployment benefit. And that is true, but that's actually not counted in terms of income. That's counted as a transfer payment. So if I give a charity €100, that's not income for the charity in an economic sense. That's just a charitable donation. It's a transfer of wealth from one person to another. No extra production has occurred, so therefore the economy is no richer. It's just a redistribution of wealth. Okay, it's called a transfer payment, a payment that is received when no factor of production is supplied. So the income method, you can add up all the income earned, the rent, the wages, the interest and the profits. Rent is the income for the owners of land, wages is the income for the owners of labour, interest is the income for the owners of capital, and profits is the income for the owners of enterprise from supplying factors of production, land, labour, capital and enterprise in a country in a period of time. Okay, and don't worry about this, revenue commission is just the tax collectors. Okay, and in the expenditure method, they can add the total amount of money spent on final flipping goods, and we understand why, guys, because the example that we've just seen, if we don't just calculate the total expenditure on final goods, we're going to be guilty of double counting, okay, and services in a country during this year. Okay, Add the value of exports and subtract the value of imports. Please don't worry about that yet. Now, this idea about double counting. Double counting occurs if the expenditure on intermediate goods, that was the wood that I chopped down for Duffy and then the tables and chairs that Duffy sold to Ski, and they're intermediate goods, is included in the calculation of national output. When measuring economic activity using the output method, care needs to be taken to distinguish between final and intermediate goods to avoid the problem of double counting. What I mean by that is that you only count the value, the selling price of the good that is sold to the consumer. Okay, so you do not count the value of the wood and you do not count the value of the tables and chairs that Duffy sold to Skian. You only count the Skian transaction, which is the selling of tables and chairs to the consumer. Sometimes it's very difficult to distinguish between intermediate and final goods. To avoid the problem of double counting, statisticians could include the final value of all finished goods with the value of intermediate goods excluded, or sum the value added at each stage of production. We have done both. Okay, as a good goes through the various stages of production, it increases in value, and it is this increase in value which is included in national income statistics. Now, I know this is a long video and I do apologize, but what we've got here is this idea of the value of sales. We have three firms: Irish Ore Incorporated, Irish Steel Incorporated, and Irish Motor Incorporated. So Irish Ore has no non-labor input costs. Okay, it just goes boom into the ground and takes out steel ore, and then what they do is they sell that for €4,200 to Irish Steel. Irish Steel melts it down and forms it into kind of like doors and stuff like that, and they sell that on to Irish Motor Incorporated, and they make a car out of it and they sell that for 21,000. Okay, so that's the relationship between these two firms. If you look at the wages, the interest payments, the rent and the profit, these are all the income that is earned by all the different factors of production. Here are the wages earned by the workers in Irish Ore, the wages earned by the workers in Irish Steel, and the wages earned by the workers in Irish Motor Company. And the same is true for all of these. These are all just the different payments that each of these firms have to make to the different factors of production. Adding across, we get 15,700 in total wages earned in the economy, 2,600 in total interest payments paid in the economy, €1,000 in total rent paid in the economy, and 2,200 in total profit earned in the economy. Okay, and the value added per firm, well, they took something that was worth nothing and then they sold it for 4,200. That's 4,200 that they've added. Irish Steel took something that was worth 4,200 and they sold it for 9,000. So 9,000 minus 4,200 is 4,800. And then Irish Steel took something that was worth 9,000 and turned it into something that was worth 21,500. So 21,500 minus 9,000 equals 12,500. Now, what I'm going to do now is direct your attention. What is the income method, the output method, value added method, and the expenditure method? And what we have here is, this is the spending on all final goods and services, 21,500, aggregate spending on domestically produced goods and services. This here is the total income that was earned by all the factors of production. If you add all of those together, you get 21,500. And this here, so that's the expenditure method, this is the income method, and this is the output method. The sum of value added, if you add this plus this plus this, I promise you, you get 21,500. Okay, now that may have confused you. You can ignore the last slide, but the only thing that I want you to know is macroeconomics rule number 3. National income equals national expenditure equals national output. Now we have 3 different ways of calculating national income. Always, always, always remember, we only care about output, because the greater that output is, the more we can consume. But I want you to understand something. If we increase one of these, by definition, the other 2 must increase. And what I want you to kind of keep in mind is, if we increase national expenditure, if everybody went out and spent a lot more money, well then that would cause national output to increase, because firms would then have to hire more workers in order to produce more goods to meet the increase in national or total demand. So there is a concept that we will be looking at in much greater detail throughout the rest of this unit, that the idea of aggregate demand, the total amount of spending that occurs, and if that increases, that will cause, depending on the situation, national output to increase. And guys, with that, thank you so much for watching the video to the end. I really hope this helped, and I really hope you have a greater understanding of these ideas and the relationship between national income, national expenditure and national output, and the very best of luck with your studies.